If you are a buy-to-let landlord, you often wonder if you're getting enough returns from your investment in the buy-to-let. Is it worth keeping your buy-to-let property, especially after implementation of Section 24? What is this Section 24? Well, according to Section 24, landlords can no longer offset the mortgage interest from the rental profit anymore. Let's see how it affects you as a landlord today.
Average UK property rent is £950 per month, which gives you 11,400 per annum. While maintaining the property, you are allowed to offset certain expenses from your rental profit. I have researched various websites and databases to offer you average expenditure figures for letting agent fees, maintenance, insurance, gas and electricity, safety certificates. On average, the property remains vacant in between the tenants for a month in a year, costing you a month's rent. A round figure for all these expenses is £3,000 per year. When you offset these allowable expenses from your gross rental income, you get rental profit after your expenses.
This about the allowable expenses. However, the major expense for most of the landlords who have mortgage on their buy-to-let properties is the interest they have to pay on that mortgage.
Average UK property costs £250,000, and with a 75% minimum loan to value, that is the amount you borrow from the bank to purchase a buy to let, you will be paying interest on mortgage worth £187,500. The average buy to let interest rate in the UK for a 75% LTV is 2%. With a 2% interest rate on this amount, you will be paying £3,750 in interest per year. Until the year 2017, the mortgage interest was allowable expense. So when you deduct mortgage interest from the rent, you get your taxable rental income. But today, you cannot offset the mortgage interest from your rental profit, and you will have to pay tax on your rent after expenses. Once you pay tax according to tax band, HMRC offers 20% tax credit on the mortgage interest. In this case, 20% of 3,750 would fetch you back £750.
These are the implications of Section 24 on your rental profit. But the take home actual profit also depends on the tax you pay on that profit. And the rental profit is subject to the tax according to your tax band. Meaning, if you are in a higher tax band with or without other sources of income, you will end up paying more tax on your rental profit. Let me explain.
So if you remember, 8,400 was an annual rental gain after allowable expense. You will pay tax and NI on this income according to your tax band. For a person without any other sources of income, this rental income will fall under their personal allowance, and hence no need to pay tax on that rental profit. A basic rate taxpayer would pay this into tax and NI, whereas a higher rate taxpayer would pay this much. In one of my previous videos, I have explained anyone with taxable pay between 100 and £125,000 pays 60% tax on earnings in that range due to obliteration of personal allowance. This group would pay more than £5,000 in tax and NI on this rental income. Remember the mortgage interest that we could not offset against the profit before the tax due to Section 24. We deduct it from our profit after tax. 20% tax credit on mortgage as per Section 24 would bring you £750. Subtracting the mortgage interest and adding the tax credit would give you the actual rental profit. While a person with no other sources of income gains maximum from the rents, a 60% taxpayer would be gaining practically nothing.
Now that we know of actual rental profit, let's see if we can estimate the actual returns on our investment into buy-to-let property.
If you remember, the average property in the UK costs around £250,000, and when you purchase it, you invest 62.5 thousand in equity, spend 10.5 thousand in stamp duty, and another 5,000 on other essential things like conveyancing, surveys, mortgage arrangement fee, decoration, etc. Adding up, if £78,000 is our initial investment in this buy to let, the actual rental profit for individual tax band is this. The current annual inflation rate in the UK is 4.9%, meaning any investment instrument that fetches you less than this inflation rate is essentially devaluating your investment as it cannot keep up with the inflation. With this rule, the rental returns from buy-to-let investment is satisfactory only for a person without any other source of income and with a total rental gain under personal allowance that is £12,500. The rental returns for basic and higher rate taxpayers are below inflation rate, but the returns for 60% taxpayer are appalling, sitting at a quarter of a percent.
What this essentially means is that the taxpayers in all the tax paying tax bands who own a buy to let property with mortgage have taken a significant hit on the rental returns after implementation of Section 24. That means for any meaningful return, they will have to either rely upon the capital growth of their buy to let or will have to look for other options of investment. Thank you for watching my video. Take care.